Good morning or afternoon or evening. We'll get started in just another minute. All right, hello and welcome to our Expat Tax Preparation webinar. Today we're going to talk about the tax filing requirements for expats, as well as some of the most important issues you need to understand when preparing your tax return. We'll also talk about the benefits of working with a professional tax preparation company. By the end of this webinar, you should understand your basic obligations as an expat, as well as some of the most common pitfalls and misconceptions. If you stick around to the end, we even have a special bonus for you. Finally, we will save a few minutes at the end of the presentation to answer your questions. They could be added into the Q&A or chat box. Either location is fine. And if we run out of time to answer your specific question or questions, we'll reach out to you directly with an email response. So let's get started. Before we dive in, let's take a minute to talk about who I am and why my advice matters. My name is Randall Brody, and I'm a licensed enrolled agent with over 25 years of experience helping U.S. expats stay compliant with the IRS. All members of our firm are either CPAs or enrolled agents. We specialize in expat taxes, and we know all the regulations inside and out. Not only have we helped thousands of expats prepare and file their tax returns successfully, but we also know all the ins and outs for dealing with back taxes and delinquent returns and compliance issues. So let's get started. We'll start with a simple but common question. Do expats really have to file a tax return? After all, you're living and working in another country, so why should the US care about your income? Unfortunately, the US is not like other countries when it comes to foreign sourced income. The US tax filing requirements apply to worldwide income, so living abroad won't excuse you from filing or paying taxes to the IRS. In fact, if you're a US citizen or resident, you are still subject to all the same filing requirements, even if you aren't living or working in the country at any time during the year. You may even need to file additional documents when you live abroad that aren't required for most taxpayers in the US, such as a report of your foreign bank holdings, known as the FBAR. Although the US requires most expats to file a return, that doesn't mean you'll owe a large tax bill when you're done. In fact, the IRS offers several tools that expats can use to lower tax liability or even eliminate it altogether, especially if you've already paid taxes overseas. The first of these tools is the foreign earned income exclusion. If you qualify for this exclusion, you can exclude a large portion of the money you earned outside the US from your taxable income. For tax year 2019, the maximum foreign earned income exclusion is the lesser of the foreign income earned, or $105,900 per qualifying person. For tax year 2020, the maximum exclusion is $107,600. If two individuals are married and both work abroad and meet either the bona fide residence test or the physical presence test, each one can choose the foreign earned income exclusion. Together, you can exclude as much as $215,200 for the 2020 tax year. This number is adjusted every year for inflation as well. To qualify for the foreign earned income exclusion, you need to meet a few requirements. First, you must have your tax home in a foreign country. Your tax home is the place where you usually conduct business. It doesn't necessarily need to be your family's place of residence. Keep in mind that the IRS will not consider you to have a tax home in a foreign country if you're maintaining an abode in the US, even if all of your money comes from foreign sources. In addition to having a tax home in a foreign country, you must also pass either the physical presence test or the bona fide residence test. To pass the physical presence test, you must be physically present in a foreign country for at least 330 days in a period of 12 months. These 12 months must be consecutive, and the period can start or end during the tax year in question. The 12-month period you use to satisfy the requirements of this test must also contain at least 365 days. For this test, the IRS defines a day as a period of 24 hours that begins at midnight. If you travel in and out of the US during the year, keeping careful track of travel time and time spent inside a foreign country is essential. To pass the bona fide residence test, you must be able to show that you're a bona fide resident of a foreign country for the entire tax year. This may sound simple, but it's important to note that simply living inside another country during the year won't automatically make you a bona fide resident. To be a bona fide resident, you have to prove that you not only do you live in another country, but that you have also established a residence that you intend to keep for an extended period. The bona fide residence test becomes more complicated when certain tax treaties are involved or when you've made certain statements to foreign governments. So it's best to talk to an expert if you're hoping to use this test to claim the foreign earned income exclusion. The IRS ultimately will decide whether taxpayers pass this test on a case-by-case basis. If you satisfy the requirements for the foreign earned income exclusion, you can use it to exclude wages or self-employment income you earned for work you did outside the US. Although you can include commissions and bonuses, you can't include self-employment taxes, which are Social Security and Medicare taxes paid based on net income from self-employment. Nor can you exclude income earned as a US government employee or passive income, such as interest and dividends. Another tool available to help you reduce US taxable income as an expat is the foreign housing exclusion and deduction. This can be used to deduct any qualifying housing expenses you paid from self-employment income, or to exclude any housing expenses paid from funds provided by your employer. Your housing amounts are calculated by your total housing expenses less a base housing amount. Qualifying housing expenses include things like rent, repairs, utilities, insurance, rental furniture, and parking costs. Certain lavish expenses, such as the cost of maid service, can't be included as qualified housing expenses. Keep in mind that there are specific limitations on this tax benefit, and the calculations can be complex. It's also important to note that you can't double dip when you're claiming the foreign housing exclusion and deduction. Housing expenses paid with income you've already excluded can't be deducted or excluded a second time. To claim the foreign earned income exclusion and the foreign housing exclusion and deduction, you must submit Form 2555 to the IRS. If you're a calendar year filer, this form will be due on April 15th with your annual tax return. However, this year, the IRS has extended the filing and tax payment deadline to July 15th. Normally, If you're living in a foreign country on the normal April 15th tax deadline, you're automatically granted a 2-month extension on the deadline for this form. So everybody has an extension to July 15th this year. There's not an automatic extension to September 15th though. So let's move on to the foreign tax credit, which is another excellent tax benefit available to expats. The foreign tax credit is designed to reduce the burden of double taxation, which would occur if you paid taxes on the same income to both the US and a foreign country. If you qualify for this, you can directly reduce your US tax liability dollar for dollar by the amount of income tax you paid to a foreign country. The foreign tax credit is available to individuals, estates, and trusts that paid qualifying taxes to a foreign country or US possession. The credit isn't available to non-resident aliens in most cases. In general, only income taxes paid on foreign source income will count towards this credit. Foreign source income includes compensation for services performed in a foreign country, foreign interest income, and foreign corporation dividends. To be considered a qualifying tax for this credit, the foreign taxes you paid must be legal and actual, which means that you legally owe them and must have actually paid them. If you could have been exempted from the tax, it can't be used to claim this credit. Qualifying foreign taxes must also be imposed directly on you. You must be able to show that you have already paid them or will have to pay them. Finally, these foreign taxes must be income taxes. If you ultimately receive a refund for taxes you used to claim the foreign tax credit, you'll need to amend your US tax return. Certain taxes are specifically excluded from this credit, including refundable taxes, taxes that could have been legally avoided, and taxes paid to governments not recognized by the US. Likewise, you can't claim any taxes paid to governments the US has designated as supporters of terrorism. You must usually file the Form 1116 to claim the foreign tax credit. However, you may be able to claim the credit without this form if you meet certain requirements. Keep in mind that claiming the credit without filing the Form 1116 prevents you from being able to carry forward or carry back as foreign taxes. You can't claim both the foreign earned income exclusion and the foreign tax credit on the same income. As a result, many expat taxpayers have to choose between taking one or the other. Depending on your unique situation, one option may be better than the other. In some cases, it may also be possible to split income between the foreign earned income exclusion and the foreign tax credit. If no foreign taxes were paid, it's an easy choice. However, if you did pay foreign taxes, the situation is more complicated. An expat tax expert can help you decide which option is best for you based on your unique situation. Even after you have applied the exclusions and credits available exclusively to expats, you may still have taxable income. If this is the case, you may be able to use other credits and deductions to lower your bill even more. Expats have access to many of the same standard benefits available to taxpayers living in the US, such as deductions for mortgage interest and state income taxes paid. Foreign property taxes are no longer deductible on Schedule A. Be sure to take advantage of these benefits to minimize your US tax liability as much as possible. Income tax is not the only US tax you need to consider as an expat. Self-employed and working in a foreign country, you're still subject to US Social Security and Medicare taxes. Unfortunately, many foreign countries collect their own Social Security taxes, leading to double taxation for many expats. None of the tax benefits we discussed so far can be used to eliminate this obligation. However, relief may be available if you're earning income in a country that has a totalization agreement with the US. These agreements eliminate dual Social Security taxation, allowing you to pay Social Security taxes to only one country. These agreements aren't available in every country, and where available, a certificate of coverage from the foreign country must be attached to your federal tax return. So it's important to do your homework. Just as being an expat doesn't exempt you from income tax filing requirements or Social Security tax, it doesn't exempt you from gift tax either. As for US residents, you can make unlimited tax-free gifts to a US citizen spouse. However, if your spouse isn't a US citizen, a special threshold may apply. For all other people, you will need to report gifts that exceed a certain threshold during the year. For 2020, the threshold is $15,000. Most taxpayers, however, will be able to use their lifetime gift tax exemption to avoid paying taxes, but you will still need to file a gift tax return. Estate taxes may apply to expats as well, and these taxes will be based on your worldwide assets. The IRS allows an exemption and estates with combined gross assets and prior taxable gifts over a specified amount. Above this amount, it may be subject to taxation. Taxes are levied on the estate, not the people who inherit. Many people mistakenly believe that moving out of the country eliminates all state tax obligations. Unfortunately, this isn't always the case. If you're still considered a resident of certain US states, you may owe taxes to that state even when you live outside the US for the entire tax year. To avoid issues with state taxes, it's important to learn about the laws in the state you moved from. Each state has different residency rules that apply to taxation. Failing to file a required tax return and/or pay state taxes can lead to penalties. Before we move on to other IRS requirements for expats, let's take a moment to talk about the importance of filing a return. Many expats who don't owe tax to the US will still need to file an income tax return. Failing to file a required return can lead to penalties. Because these penalties can be serious and you may lose out on important tax benefits, ignoring the obligation to file a return is never a good idea. So be sure to file on time every year, regardless of your expected tax bill. Filing tax returns isn't the only responsibility you have as an expat. You may need to file information disclosures to the IRS as well. One of the most common disclosures required is the FBAR. The FBAR stands for Foreign Bank Account Report, which is also known by its form number, FinCEN Form 114. This form is required by the IRS to aid the US government in determining if a US taxpayer is evading US income tax. The FBAR requires you to list all of your foreign financial accounts, including bank accounts, mutual funds, brokerage accounts, and more. Another common international disclosure is the Form 8621, which is generally required whenever you invest in a foreign mutual fund. The US classifies such investments as PFICs, which stands for Passive Foreign Investment Companies, and as such are subject to very punitive and costly tax disclosure requirements, along with very high tax rates. So this is an investment we typically recommend that you avoid. An FR may not be required for every expat taxpayer who has assets overseas. However, if you're a US citizen or US resident with significant financial interests abroad, you probably need to file this form. Specifically, you must file the FBAR if you have a financial interest in or signing authority over foreign accounts with an aggregate value of more than $10,000 at any time during the year. Foreign accounts include any account held at an institution outside the U.S. Keep in mind that you must file this form even if you have only signature authority over a foreign account. Likewise, even if the foreign account produced no taxable income, its balance still counts for the purpose of the FBAR filing requirements. Keep in mind that the filing threshold for the FBAR is based on the aggregate balance, not the individual balances of each account. Even if none of your accounts had a balance over $10,000 during the tax year, you'll still need to file this form if the total of all account balances were higher than the threshold at any point in time during the year. Because the FBAR is only a report, it's common for expat taxpayers to view it as no big deal. However, this is not an IRS requirement you can afford to ignore. It is a big deal for the IRS. If you don't file a required FBAR, you may face fines and penalties from the IRS. Failing to file an FBAR can even lead to criminal charges. It is also a deceptively easy form to complete in that it is easy form to fill out, but easy to make costly reporting errors and omissions by not knowing what needs to be reported and how. You may think you can fly under the radar with this requirement, but the IRS will know if you don't file. Foreign financial institutions are required to collect and report certain information about accounts owned by U.S. taxpayers, giving the IRS everything it needs to discover your unfiled FBARs. Like your tax return, FBARs must typically be filed by April 15th. However, the last couple years, an automatic extension until October 15th has been granted for those who missed the April 15th due date. You must file this form every year your foreign accounts meet the threshold. Another form some U.S. expats must file is Form 5471, which applies to U.S. persons who are officers, directors, or shareholders in certain foreign corporations. This form reports the activity of the foreign corporation to the IRS. Like most international disclosures, it carries the potential for hefty fines if not filed on time or accurately. If a certain threshold is met, you may also need to file the Form 8938, the Statement of Specified Foreign Interest as well. For a single U.S. resident, that threshold is $50,000 on the last day of the tax year or $75,000 at any time during the year. For a couple that is married filing jointly, it's $100,000 at the year end or $150,000 at any time. For single taxpayers residing abroad, the threshold jumps to $200,000 for year end and $300,000 at any time. While taxpayers filing jointly and residing abroad must meet the threshold if total foreign specified assets exceed $400,000 on the last day of the tax year or $600,000 at any time during the year. Keeping up with all the IRS and tax payment obligations is essential for all expats. Unfortunately, many expats simply aren't aware of the IRS filing requirements, and as a result, may have multiple unfiled returns and/or back taxes, or even incomplete or missing disclosures. If this is the case for you, you need to move quickly to minimize the consequences. The longer you leave the situation unresolved, the more likely you will have to face harsh penalties. The first step in this process usually involves filing all the returns you missed and coming into full compliance. You also need to take steps to resolve any tax debts you owe as applicable. Fortunately, the IRS offers several options for taxpayers who want to resolve outstanding debts. So at Tax Samaritan, we specialize in helping expats with all their U.S. tax needs, from filing returns to resolving unpaid tax debts. If you have unfiled returns or international disclosures, we can help you deal with these issues quickly as well. Please contact us to learn more about our services. If you're ready to move forward, respond to the email that we'll be sending very soon. If you're not quite ready to take that initial step, we can offer a private, no obligation chat with you. Just call or email us and we'll be able to start helping you. If you would like to receive a complimentary copy of our Expat Tax ebook, please visit the following link that you see at the bottom of this slide, and we'll be happy to send that to you. At this moment, we have a few minutes left that we can answer some of your specific questions. You can feel free to post those into the Q&A or chat window, and I'll be happy to answer your questions. All right, and we'll take a few minutes to see if there are any questions. All right, our first question. If you filed in many years, is it necessary to file every missing year? Is there an amnesty program where you file the last 3 years only? So it's a very common misconception as far as statute of limitations with the IRS. There are no statute of limitations when it comes to unfiled tax returns. So in theory, the IRS can go back indefinitely. They can go back 10, 20, 30 years for unfiled returns. I have seen that happen on occasion. However, generally, when getting back into compliance, the IRS is looking for tax returns for the prior 6 years. There is an amnesty program called the Streamlined Foreign Offshore Procedure. Within the protection or confines of that program, it requires that 3 years only. However, the 3 years that are filed from that program are just the 3 years that can be protected under that amnesty program. It does not protect you from 3 years prior, which is still recommended by the IRS to file those prior 3 years. So 6 years prior is generally what we recommend. We have a very conservative approach with coming back into compliance. What are the consequences of filing a PFIC or a controlled foreign corporation in error? And how do you fix that? That's a very good question. There are a number of consequences. With the PFIC specifically, there are no penalties assessed for failing to file. However, the consequence of that, as well as filing a CFC in error, is that the IRS can deem your return to be unfiled. So they could reverse the filing of your return, which can enable them to assess all kinds of penalties for failing to file a return. So they can assess penalties in every other area of the return. And I've seen that happen on occasion. With the controlled foreign corporation filed in error, the IRS can assess a $10,000 penalty for each month, up to 3 months that the Form 5471 disclosure is not filed or filed inaccurately. In one of your emails, you mentioned that there is a waiver for the physical presence test due to the COVID. Yes, there is a special exception this year if you meet the parameters of the exception, depending on which country you left and returned to the US and the date that you returned, you may qualify for that in order to qualify under the physical presence test. The specifics of that, please feel free to email us and I'll be happy to send you the details of what those specific rules are. All right. In regards to the FBAR, the statute of limitations is a bit different than a return. There is a statute of limitations for the FBAR of 6 years. So the 6 prior years should be filed and reported. If there's a failure to file and the failure was due to non-willful reasons, in other words, was not intentional or willful failure to file, you should come back into compliance under the streamlined offshore procedure. Assuming that you qualify, that would be the best approach, absolutely, to go back and report those years. If you'd like to schedule a private chat with us, just feel free to email us and we'll be happy to schedule that so we could talk about the specifics of your situation. The question is, if you don't owe taxes in the US, is it likely there would be any penalties for failing to file? So if there's no tax liability, there are no penalties for failing to file or failure to pay, of course. The risk, though, is if you have no tax liability after taking into account the foreign earned income exclusion, and the IRS has asked you for a missing return before you have an opportunity to file it, the IRS or the US government has the opportunity to deny your claim for the foreign earned income exclusion. So you can be made to be ineligible to claim that exclusion. So as a result of that, you would have potentially a tax liability, and from that, penalties as well. You're welcome. Most happy to help. Failing to file past 15 years. Again, generally what the IRS will request anytime you ask is to file the prior 6 years of returns. As part of any engagement, we'll do background research on your account with the IRS to see if there's any compelling reason to go beyond the 6 years. That is not too common, but it happens on occasion. If there's a lingering issue beyond that 6 years that the IRS has requested information, they will typically demand a filing for that year or years. All right. It's my pleasure. Happy to be of help. If you have other questions, feel free to type them there in the Q&A box. Again, if you'd like to schedule a one-on-one chat, it is complimentary. Just shoot us an email at help@taxsamaritan.com and we can send you a link so that you can schedule a time to chat at your convenience. If the return is deemed unfiled because the 5470 was filed when it should have been a PFIC and there were no taxes owing on the return and no foreign income exclusion, would a penalty still apply? Yes, it can. It depends on whether the IRS chooses to assess a penalty. Yes, they can assess a penalty in that situation. Whether they do or don't is unknown. The recommendation, of course, is to generally amend the return. There may be a special disclosure that can be done. There's a variety of options besides the streamlined foreign offshore procedure, including the delinquent international information return procedure, where we can provide a statement of reasonable cause to accompany a revision of your return. Typically, that would be, the best approach if eligible, based on that specific type of situation where the wrong forms were filed. Missed the beginning of the talk. Will be available in its entirety somewhere when it's finished. Unfortunately, no, there is not a replay, but later this month, if you click on the same webinar link that you used to register, there will be, I'll be presenting this same webinar later in the month. All right. Thank you so much, everybody, for your time. It is much appreciated. And I hope you all stay safe and healthy, and hopefully talk to you soon. Take care.